It is my pleasure to introduce Kevin Siskar, who's CEO and co-founder of Finta, and Matthew Pelkey, who is the managing partner for Colligan Law and the program director for the Entrepreneurship Law Clinic. Both of them are going to talk to you about pro forma cap tables, which I will admit I have absolutely no knowledge about. So I'm also going to be joining you and learning what exactly these are and getting a little bit of knowledge today. So without further ado, I will turn it over to you. And Matt, I'll let you kick us off first.
Everybody, Andrew, thank you for the introduction, and everybody, thanks for hopping on. It's really great to see this many people for a presentation on cap tables. So I thank you all for joining us. I'm going to go ahead and share my screen. As Andrew said, we're here to talk a little bit about cap tables. One of the things that I think is necessary before you can even start talking about what a pro forma cap table is, when you're going to use it, how you're going to use it, is understanding where it fits into sort of your startup as a whole. And that's going to require us to get into a fair amount of legal sort of questions and subjects. This is really just a disclaimer to make my malpractice carrier happy. Basically, while we're going to go through a fair amount of points today, everybody's facts and circumstances are unique, and you're going to need to actually consult with a lawyer about your specific facts and circumstances. This presentation doesn't create attorney-client relationship. You're not going to have attorney-client privilege. If you ask me questions in here, they're not going to be covered by attorney-client privilege. There is no attorney-client relationship. So now that that's out of the way, cap tables fit within a category that lawyers like to broadly call governance. And it is sort of structuring your incorporation, making sure that you're holding regular meetings, you have annual meetings, you have your minutes, you have a minute book. Once upon a time, that was actually a physical binder. Less so nowadays. Most people use a digital minute book, or they're using a sort of minute book management system that documents all those resolutions. As a lawyer, I don't care. Whatever works for you, as long as you're doing it. Obviously, if you're using a software system, that can have a cost to it. It's often cheaper just to store these things on a Google Drive or a cloud drive, especially early on. Totally fine with that. And then the last piece here is accurately documenting your cap table. So what do we mean by cap table? Well, your cap table is actually your capitalization table, is what that stands for. So if you were, actually drag that out, we're talking about the capitalization of your company. What is capitalization? Capitalization refers to the equity stakeholders in your business. That can be common shareholders, which are often the founders. That can be preferred shareholders, which might be your investors at a priced round. It could be early stage investors through a SAFE or a convertible note. It also could be options with key employees or warrants. There's a lot of things that can get picked up in that. And the idea is that your cap table is a physical table where you manage all that. You track it. You have everything in there so that if someone needs to know, hey, who are the owners or who has an ownership interest in this company, you can very easily produce that. So why does it matter? Well, it's easier to operate with that kind of clarity. I can tell you as a lawyer, we'll get clients who come to us who have some sort of event that necessitates it, usually a financing. That could be commercial. That could be an investor-led round, venture capital, investors, whatever. They've done no governance. They've not tracked their cap table. They've done a poor job of documenting these things. I will tell you, it will cost you a lot more to have me or another lawyer go back and clean all these things up after the fact than to just get in the habit of doing things right from the start. Lawyers, investors, we love good governance. We love an accurate cap table. I will absolutely tell you, banks, investors, VCs, whoever you're working with will absolutely want to see not only an accurate cap table, but the governance documents backing that up. It's also a good way to prevent disputes. I see this a lot with sometimes people promising someone an equity stake in the company, but not actually documenting it, promising equity to employees without properly documenting it, or even just accidental co-founders where you didn't really give a lot of thought to how that person's playing in. Now we've got a dispute over the ownership. We've got a dispute over how much someone has as a percentage, et cetera. As I noted, this can be very costly to clean up. And if it is bad enough, and I've seen this on occasion, it can actually be prohibitive to a transaction where an investor basically says, you know what, we're not ready, or you guys aren't ready at this time. You need to go figure this out on your own, clean it up, come back to us when you have. And maybe there are issues that can't even be cleaned up, which obviously is problematic. All right, so equity. What is equity? Well, equity, again, we're talking about capitalization. Capitalization is equity. Well, what's equity? Depends on your entity, right? Equity is the ownership interest in the company. This can be represented in a corporation as shares. Pretty much always is. There's options, there's some other things, but 99% of the time it's going to be shares. Or in the case of a limited liability company, you may have something called membership units or membership interests. LLCs are members, corporations are shareholders. Okay, there's an important distinction there. Sometimes people sort of conflate these. That is effectively the equity we're talking about. Now, if you have a partnership, let's say it's an LLP or it's just a general de facto partnership, that equity interest at that point is going to be a partner. I assume nearly all of you are fitting into either the LLC or the corporation category. And if you are looking to raise money from investors or you were looking at that high growth venture route, then you really should be set up as a corporation, most likely a C Corp, probably Delaware. We can talk about that if you want, or why that's preferred. Generally speaking, it's preferred because the investors prefer it. So if you plan on raising money from investors, just save yourself the time, set up as a corporation. In that case, we're talking shareholders, we're talking shares. The equity, the capitalization is those shares. That's what we're talking about. So I get this question a lot, especially when we're talking about cap tables. How do you determine that initial equity? And Kevin, I know you in Founders Institute have had these conversations. I will tell you there's not a right or wrong answer. And as a counsel, as attorney, it's kind of an awkward situation for me to be in, especially when we're representing all the founders, because I can't be the one dictating that. At the end of the day, the initial equity between the founders is what's fair and equitable between the founders, which is kind of circular. But here's what I usually do. It depends on the contributions, right? If someone's going to be active in the business, if they're going to be passive, if they created the intellectual property, they're going to be raising, most of the capital for the company. If they have a very small role and are going to be part-time, then maybe they get less equity. I'll oftentimes see, well, there's 3 founders, we're each going to get a third. Sure, you can do that. Is everyone contributing equally? And that might be equitable. If they're not, then maybe that needs to be adjusted. There are some tools to help with this. I know Carta has one. Kevin can show you a little bit about that later. Gust Equity Split is another tool. There's also Slice of Pie, which I don't like as much, but it's out there. And what these will do is effectively take your individual facts and circumstances, run them through an algorithm that compares it to their portfolio of companies and then says, hey, based on the information you've provided us, here is what other companies under similar facts and circumstances have done with their initial equity. It's not binding. You can ignore it if you choose to, but it's at least a good starting point for you to sort of do a temperature check and say, hey, are we in the ballpark, right? And then from there, negotiate, right? Well, I'm only going to be working 10 hours a week on this. Okay, then maybe you should get a little less. Well, I created the intellectual property that we're relying on and the company wouldn't exist without me. Well, maybe that's a justification to do a little more. And so these are all things to think about as you are calculating who gets what. I will say, again, going back to governance, it's important to document that. Especially if it's a corporation, you're talking about shareholders, make sure you've got resolutions, papering that and documenting it. If you're actually issuing physical shares, which is less common now than it used to be, that will be a physical piece of paper that has a certificate, a share number, etc. You don't have to do that. I just raise it because it is out there and you will sometimes see that language being used. You can use non-certificated shares, which means there are no certificates. You can also use electronic shares, which Carta and some other platforms have, which are effectively the same thing, just in electronic format. I don't want to spend a ton of time on that. I just want you to be aware of that so that if it comes up, you're not confused or wondering what's going on. I do want to make an important note about issued versus authorized shares, only because in the e-law center, we see a lot of people mess this up. When you're creating your company in your certificate of incorporation, you have to set out the total authorized universe of shares. Okay. Let's just say it's 10 million. Okay. That is the total number of shares that you can give to people subsequently, right? That's like your bank account balance. Issued shares are the shares that you've actually given to people. When we're talking about cap tables, especially for purposes of ownership percentage, the authorized but not issued shares do not count. I will see some people say, well, I'm authorizing 10 million shares. I want to have 100% of the company. I need to issue 10 million shares myself. No, that's absolutely not correct. You could have 10 million shares, issue one share. Okay, let's say I issue one share to Kevin. Kevin is a 100% owner of that company because there is only one share. It is the issued shares, once you give them to people, that actually count for dilution purposes, for equity percentage purposes, for when you're figuring out the pro forma. You want to be aware of your total authorized because that's how many you have. So if you're going to go out and bring an investor in and they want 20 million shares, but you only have 10 million authorized, you have to go back and amend that to add more. It's like putting more in your bank account, right? I sometimes use, the analogy of, cars being manufactured. I don't know. I don't have a perfect analogy for this, but basically the idea is think of those unissued shares that are authorized as your inventory. Has not been issued yet. Probably hasn't even necessarily been made yet, right? But when we're talking about equity percentages, cap tables, what's important is the issued will usually reflect the total authorized but unissued, what's left, but it doesn't get factored in from a percentage perspective. People mess this up all the time. Clients mess it up all the time. Even some students mess this up all the time. Just something to note so that you don't make the same mistake. Now, what about when we're talking equity for investors? Well, first, your initial equity to those founders is typically common shares. It's voting. They have the same rights. They participate pro rata. There's usually no preferences. You're just basically, that's your founder's equity. When investors come in, this can happen in a couple different ways. Early on, when we call sort of like seed stage investing or pre-seed or whatever, it seems like every couple of years they just move that needle back further. You're going to see this through a convertible instrument. It's typically a safe or a convertible note. We're seeing safes more often than we did when I first started this program. And these are basically a way for an investor to invest in the company, to give you capital without actually getting equity at that time. And you might be like, well, why would they do that? Well, because at this juncture, figuring out the real valuation of the company is difficult. And in order to have priced equity, to have those shares in the company, you kind of need to know what that valuation is. And early on in a company's life, that is a super speculative thing. And so one of the ways we get around this is we say, listen, we'll use a convertible note or a safe. If somebody has questions about those differences, have at it. But basically what it is I'm going to give you money as the company. If you go out down the road and raise equity, that will then convert to shares as part of that priced equity round. Priced equity typically comes in the form of preferred shares as opposed to common. When you have preferred shares, that will include preferences, economic rights, liquidation rights, voting rights, things that the common shareholders don't get, right? It's like an advantage over the common shareholders, but that's why they're investing, right? They're doing that to protect. And this is all a negotiation. If you have counsel involved, if you're experiencing this, there might be some back and forth. Well, what's the liquidation preference? Is it participating? Is it not participating? Is it 0.5? Is it 1.5? All these things get negotiated. Maybe there's a dividend preference, etc. Okay, we talked a little bit, what does a cap table look like? I'm going to show you all an example. There is no right or wrong form. Okay, there are some that are better than others, but as long as you are tracking it as an attorney, I'm okay with that. You want to do it in a Word document, probably not as efficient, probably making your life more difficult, but have at it. You want to do it in Excel? I like Excel. You want to use cap table management software? Even better. The point is, make sure it's documented. Conceptually, you could write this on a legal pad of paper and shove it in a desk somewhere, and that suffices. I don't recommend that, but it is conceptually sufficient. Your cap table is just a mechanism to track the equity and the capitalization of the company. You're basically breaking down those shares and those equity interests. When you're doing that, what's important, you want to make sure it's accurate, consistent, stay on top of options. It's important when we talk about pro formas to understand the impact of those financings. So Kevin's going to dive a little bit more into this, but okay, you have your founder's equity. What if we're going to go out and raise a Series A round and you're going to issue 5 million shares? What is the dilutive effect of that going to look like? What does it look like if those convertible notes and safes convert to equity? How does that play in? Your scenario planning. That's what we talk about when we're talking about pro forma. Pro forma is basically forward looking. What does it look like in these certain scenarios? If you do all these things, it's going to make due diligence much easier and will ultimately save you a lot of money. I'm going to give you an example of just what a pro forma cap table effectively looks like before we dive into it with Kevin. This has founders, investors, and options. So this was done just in Excel, but you can see common shareholders, Series A, are on here, and you can sort of see what the various percentages are. Hopefully they make these slides available to you all afterwards, or we can, and that way you can spend a little bit more time with this. But you can see, founders equity here, investor equity here, and then you've got your equity incentive plans and your options down here, and you can see the various percentages that those make up. And does a cap table really matter if I don't plan on having investors? Yes, I can tell you it matters for commercial financing, grants, avoiding ownership disputes, and also may actually be necessary if you're even opening a bank account these days. So with that, I'm going to turn it over to Kevin.
Sorry to interrupt, Matt. We did have one quick question.
Sure.
I think if someone has an LLC under their name and they have sole proprietorship with their startup, should they look and change into a corporation once they aim to raise their pre-seed, or?
Yeah, so this is actually a tricky question. If you're already an LLC, the good news is you're a disregarded entity. So if you're a single member, it's disregarded. I'm actually going to find an article I wrote through BEP. Basically, the issue you run into here is, generally speaking, with no tax consequences, sure, that's a really easy thing to do. You can convert. Some investors may even invest with a convertible note or a safe and just say that you need to convert to a C Corp before those instruments convert to equity. The problem is, and this is where I'm trying to find an article I wrote, and I can provide it later. If you just search business entrepreneurship blog, Matthew Pelkey, there's an article on this. The problem can come in a couple different ways. If you have a lot of inventory or you have accounts receivable and you're in certain industries, there's something called the hot asset rule. And basically what it can mean is that upon conversion from an LLC to a corporation, all of that inventory and all of those accounts receivable end up having to get treated as income upon the conversion. Why does that matter? Well, let's say you had $250,000 in inventory. You go from an LLC to a C Corp. You now have $250,000 that gets picked up as income for your business, and there's no cash coming in. What does that mean? You now have to pay taxes on $250,000. So in the hot asset rule scenario, you can end up owing income tax on an amount that you never actually received income from. So that can be a problem. The other issue there is if you're raising a significant amount of money from convertible notes and you're taking losses and you are claiming those losses on your income tax personally, which is one of the advantages to an LLC, under certain circumstances, you could end up having to basically pay phantom tax on those losses when you convert to a C Corp. There are some instances where this makes sense. And what I usually say is if you are planning to self-finance and you are putting in a considerable sum of your own money and you plan to operate at a loss for the first few years, then do it, because you get the advantage of those losses. You can offset that against income that you might have elsewhere. And then, yes, it's going to cost you a little bit of money to convert, but as long as you're still, and this is where like scenario planning, some of this makes sense, and working with an accountant and a professional, because it's not an easy yes or no answer. If it's enough money that you're personally investing, then the losses that you're going to take, even if you have to pay additional costs to convert, actually are still a net benefit to you, and it's worth it. If you only plan on putting in $500 of your own money, probably not worth it, because you're going to end up spending at least, even if you use the e-law center, probably $500-$600 of your own money to convert. If you have to go out and pay a lawyer to do this, you'll be spending several $1,000s, if not more. And I've heard horror stories of, $20,000 people have been charged to do these conversions. And again, some of that can be dictated by these tax issues, but all things being equal, you might as well just start out as a C Corp to avoid basically the last 6 minutes of issues that I've been trying to give you a brief overview on.
Yeah, I'd see in the field, I've seen companies pay north of $10,000 to $20,000 to convert, because once you have real revenue in a real company, your assets add up.
Yeah. Yep.
So quick background for you guys. My name is Kevin Siskar. I'm the co-founder and CEO of Finta. Between 2015 and 2020, I helped 160 some companies start in New York City through a program called Founder Institute. It was a lot of fun back when things were still in person and everything wasn't over Zoom. People were together, cameras were on, mics were on. It's a little. Then I worked at 43 North for 2 years, invested about $10 million into 12 companies, started a podcast where I interviewed a lot of mentors for these programs, and that's for free. You guys can go check out Ambition today. But what we saw was that running deals was really, really hard. Especially when it came to like network-driven deals, meaning you need warm intros, you're using a lot of your relationships. And so when we saw that warm intros worked really well for things like fundraising, high-ticket sales deals, we started to build a software to automate a lot of this. And so, not to bore you guys too much, but we have a little class we put together called Finta Academy that we're actually going to give away for free in February. So if anyone wants to join it, I'll put my email in the chat here, and if shoot me your email, and I'll add you to it if you want to learn more about fundraising. We're going to skip intros. All right, and then here's my disclaimer: is I'm not an attorney, so you should listen to everything Matt says, and I am just giving advice. So really quickly, what are you doing here? You're going to raise some friends and family, typically less than 100,000. You might get some angels to bring you to 500,000, 200,000, somewhere around there. And then you're going to raise the first institutional round. And to Matt's point, that these rounds keep sliding later, and we keep inventing newer terms for the earlier round. But it precedes like 1 million, 1.5 million right now. Seed is like a $3 to $5 million round. Series A is like a 10 million. Series B could be 20 million, 25 million and up. As you build your company, you're trying to prove different things at each of these stages. So initially, you're trying to prove that you could even build some technology or some sort of advantage. At the seed, you're trying to prove that you could bring it to market. At the Series A, you're trying to prove that you could scale it. The B, that you could be profitable. The C, you could get the IPO, etc. So what are the legal docs on your cap table that let you do this? Well, first of all, like Matt said, everybody is typically a Delaware C Corporation today. And the cost on this has come way down. When I incorporated my first company in 2012, I think I paid like $5,000. Now, if you use something like Stripe Atlas, it could be $400.
And the e-law center, you can do it for cost.
At the e-law center, you can do it for cost. Here's what you should not do, which I am starting to see. Do not chat GPT your legal docs. That's insane. Recently, we've been coming across legal docs that literally, even at the bottom, still say, let me know if you'd like me to keep going on the next steps. They didn't even edit them. They just copied the whole thing and pasted it in and submitted it as legal. But the last thing on Delaware is it's basically just the oldest state in the union. So it has the biggest the biggest legal history. So investors trust it. And then the other problem to the question before with you being an LLC is their pass-through. So if your company loses a bunch of money, and the investor is also an LLC, well, then the debt and the losses could pass through. And investors want this layer of protection. They also want the value of the stock to accrue in the stock and go up. Did I get that right, Matt?
Yeah, and listen, I think there's a lot of reasons. One of the primary financial reasons that investors require you to be a C Corp is qualified small business stock. There is a significant tax advantage to doing that. And because of the passive ownership tax structure of LLCs, they don't want to be filing they don't have to deal with K1s for every business that they're involved with, every year. And so, but from a bottom line perspective, that qualified small business stock tax exemption is a significant benefit on an exit transaction.
Yeah, and what that is, guys, is basically up to, it just changed last summer. So up to $15 million of capital gains is excluded if you've held that stock for 5 years.
Yeah.
And convertible notes, safes, they don't count as that, right? Only priced equity does. So common stock, preferred stock. And so you want to start the clock on that sooner than later. So there's basically three main ways that you can, add investors to your cap table. There's other stuff you can do with employees like stock options, but I'll quickly sort of give you guys the rundown on these three here. So convertible notes and safes are essentially debt that can convert into equity. They're the cheaper, less expensive way to take an investor in. And there's really two differences between these, right? So convertible notes got invented in 2013 as an improval. Safes got invested in 2013 as an improved version of convertible notes. Convertible notes typically have a maturity date and an interest rate. And so once they mature, there's a fixed payment schedule. Y Combinator came out in 2013 and said, well, typically only bad investors would enforce debt on the company they just invested money into that they want to see grow. And so it doesn't really make sense to kneecap a founder who you're trying to help. And so the SAFE basically got rid of those clauses. YC came out with the pre-money template in 2013, and then they updated that to the post-money template in 2018. That's now sort of the standard. A lot of this has sort of been adopted since 2020. And so you can see here sort of the death of the convertible note in blue from 2020 down to 10%, or started around 50-50. And post-money safes have really taken off. They're now about 90% of deals. This is the national average. You'll see more pushback in cities that are not sort of tier one venture capital cities. Someone I would recommend following, and a lot of the data that I share comes from is this guy named Peter Walker. He's the head of insights at Carta, which is a cap table platform company, and he just anonymously publishes platform data constantly, every single day. How much equity should you and your co-founders get? There's a chart for that, right? He has a lot of data, and to Matt's point, like these things are more art than science, but I think it's really cool that you can be empowered with a lot of the data, because a decade ago, honestly, it did not exist. It was the investors had all the information because they saw deal after deal, 2,000 deals a year. The founders had one deal, their own. And so they were sort of living in the dark. And so now you can be empowered with a lot of that. Okay, so that's safes and convertible notes. Typically, the switch to priced equity happens between 2 to 3 million. So the orange here is where priced rounds kind of start to happen. Safes are in black, and you can see it's like 50-50 right around here. And so why does priced equity happen later? It's because it's expensive. A safe doc, a convertible note, they could be, half a dozen to a dozen pages. Priced equity docs can be dozens of pages. And the average cost to do a round, goes from $20,000 to $60,000 essentially in just legal costs.
Yeah, Kevin, what I'll do is if folks are interested in seeing what priced equity docs would look like, a lot of folks standard just use the NVCA model forms as at least the starting point. I'll dump a link to those documents. If you want to see the difference, peruse through them at your convenience.
Yeah. Yeah, you guys can go to the YC website and download the Safe Note or Safe. I got corrected by the guy who used to run YC. It's not a safe note; it's a safe. And then the Venture Capital Association publishes the legal template for priced rounds. And what's cool about this is actually as the SAFE came out and created standardization at the pre-seed and friends and family, the Series A docs that Matt's talking about also became adopted as sort of the standard docs. And so venture capital as an industry has really professionalized over the last decade, which is great to see. Equity starts the clock on QSBS. We'll skip over seasonality. Just know that you don't really want to fundraise in August or December because people are busy on vacation. And let's quickly go through terms. So any questions on the legal docs before we get into what are sort of the terms on the legal docs? All right, we'll keep going. And if you guys could do me a favor, like put in the chat what are you working on? Do you have a company? Is it already incorporated? What are you doing? So I can kind of tailor this to be most helpful. There's some key terms on these legal docs. So the amount, this is how much you're fundraising, right? You should base this on like a real financial model that you've built. And typically what you want to do is figure out how much money you actually need for 18 months to 24 months. And then that's the amount. The valuation cap, and I can give you some stuff at the end here. Founders always want to push for a higher valuation cap. I actually think that's wrong. I think all you're doing is making it harder for yourself in the future. What you're really trying to do with the valuation cap is manage for dilution. You don't want to sell too much of the company so that you don't have enough equity to sell for the next round, the seed, the Series A, the Series B. Discounts are typically 20%, but they're kind of going away. Valuation cap only or discount. It's typically one or the other now. The dual combo is taken off the YC website, and so that's been kind of fading.
Yeah, I do want to note on that real quick, Kevin.
Yeah.
If you're a founder and you find yourself in a position where someone on the other side is using a safe or even a convertible note, and they are looking for both a cap and a discount, that's a term you can negotiate. Push back on that. And I will tell you as counsel, that's one, unless you've signed already, that's one of the first things I'm going to tell you is, you know what, like market standard is either or, push back. I will tell you at UB, what we often do is build it in that it is either or at the discretion of the investor. And that's at least a compromise where they're given a little bit of flexibility there. But I do think it's pretty predatory to actually utilize both.
Yeah. And if I go back a bit here, you guys will see if you go to the Y Combinator website, which is where these are hosted, the defaults here are now valuation cap, no discount, or discount, no cap. So they're sort of both ways there, but not both. Sorry, good stuff. All right, where were we? Okay, the other things you should know about if you do a convertible note. Interest rate, it's only on the convertible note, but it's the percent at which you're going to be, charged interest. Pro rata is an interesting term for you guys to know. So pro rata is the right for an investor to invest again in the next round and maintain their percent. So if Matt invests in my company and he buys 5% of it, 2 years go by, I go to raise the next round and he has pro rata, he can invest again to maintain his 5% and avoid getting diluted by the new investors. Sometimes you guys can use pro rata as a side letter to, hey, if your check size is bigger, you want to invest 200,000 instead of 50,000, I'll include a pro rata side letter. Most favored nation, this seemed like it was going to get popular, and it's something you should be aware of because it's in some docs, but basically means if I give, I'm going to just keep using you, Matt, here. If Matt invests in my company last week at a 5 million or at a 10 million, and then next week, Andrew invests at a 5. Well, then Matt retroactively gets the better valuation. He gets the 5. So an MFN clause lets all future investors participate at the best terms into the future, essentially. And then the last one that you guys should know that you should avoid like the plague is a liquidation preference. So if you could ever take a lower valuation that doesn't have a lick pref, you should do that. So in the .com boom, like these ended up going to like 5x. I have friends who took 1.5, 2.5x liquidation preferences, and they regret it. But basically, this is the right for an investor to get a multiple on their money back before any of the common stock gets paid out. And the common stock is the founders, the employees, the stock options, the team that's putting in the blood, sweat, and tears. And so if an investor invests 25 million and they have a 2x liquidation preference, that means they need 50 million back before anyone on the team gets paid out. Well, if the company sells for less than 50 million because you had a bad quarter of revenue or something like that, well, then everyone who just worked for 8 to 13 years is getting nothing, essentially. So if you can ever avoid liquidation preferences, you should. And Matt, I'll ask you, like, they're coming back. So things got very founder friendly in the 2010s, and now the pendulum is swinging back towards investor.
I think as you've seen, sort of the economy shift, over the last 5, 6 years. You've seen investors get a little bit more risk averse. And I think liquidation preferences, more so obviously at the preferred priced equity round. I think at the seed level, other than just sort of what's in the standard Y Combinator safe, it would be unusual. But I do think at the priced equity round, we do see it now. I will say it's not as egregious as some of those numbers. What I have often seen is sort of a 1x preference, which is basically we get our money back before anybody else gets money. I think you can sort of, that's not an unreasonable position for them to take, but it's something that can be negotiated. And then there is a question, right? Is it 1x and participating, or is it 1x and not participating? Because that makes a big difference, right? Because if it's 1x and participating, then they're kind of getting the best of both worlds. If it's 1x and not participating, then it really is a liquidation preference meant to give them.
Do you want to unpack participating for them, Matt?
Yeah. So participating means
a term in the legal doc.
Yeah, participating means if the company's being sold either at a significant gain or in a distressed situation, you have your liquidation preference, which is typically expressed in that 1x, 0.5x, 2x, 3x, 10x, whatever. That is just the number that they are guaranteed to get back before anyone else on the cap table sees a dollar. Okay. Participating says, okay, after that liquidation preference, let's say we sell the company for $1 million. I had a safe, or I had a preferred equity that was worth $100,000. I'm just making this real simple. And I had a 1x liquidation preference. Okay. That 1x means I get my $100,000 out of that million before anyone else sees a dollar. Participating says, well, what happens after that point? What happens with that pool of $900,000 that's left? Participating means I get to share in that pro rata with everybody else. Not participating means I don't. And so where this kind of game gets played is if it is, let's just use a 1x liquidation preference, because I do think that's probably the more common result these days. If you have a 1x liquidation preference and it's participating, then you get your money back and you get to participate pro rata with the rest of that pool. If it's 1x and not participating, then you get your money back, but you don't participate in the larger sum. Now, from an investor's perspective, you might say, well, why would anyone do that? Well, they also have the option to convert to common shares prior to that liquidation event. And so if it is more beneficial to that investor to go ahead and convert to common because they'll get a larger piece of that pro rata sum, right? Let's say it's a $10 million exit transaction and we've only got a $100,000, initial investment. Well, then it probably makes sense to ditch the liquidation preference, convert to common, and then share in the total pie with everybody else, right? So this is kind of the back and forth game that gets played, but it comes in because you start negotiating these terms in the term sheet. What's the preference? Is it participating? Is it not participating? Maybe you give a higher liquidation preference, but it's not participating, or a lower preference and it is participating. It's all fun.
Nice. All right, let's just jump to my last bit here, which is what you're really trying to control for is dilution. So what you don't want to do is sell 80% of your company in that first round, and then you have none of the pie left for the next round. So typically you don't want a broken cap table, essentially. And that's really what you're trying to manage. And so here's what the dilution looks like on average, again, for Peter Walker. Seed round, you're going to sell 20%, Series A, 18, median, Series B, 15, right? And so you want to manage for that. The last thing I'll sort of leave you guys with, I'm not going to go into valuations and whatnot, but basically, if you are going to fundraise, you're jumping through a series of hoops, essentially. So you might raise 50 to 250K, get that friends and family, get that MVP built.
Actually,
go on into a pre-seed where you've built the MVP. From there, you kind of need to get to $500,000 in revenue. This bar is going up as vibe coding is making things easier. You need to get to $500,000 in revenue to unlock a seed round. The seed round you got to deploy to get yourself to 3-ish million to unlock an A, raise 10, get to, so you're kind of jumping through these hoops, and you always want to make sure that when you build these financial models and you're figuring out that amount for 18 to 24 months, that it's going to give you enough to make the hires you need, to execute the strategies you need to get to those next thresholds. Otherwise, you'll sort of get stuck, and that happens all the time. At each of these phases, basically there's graduation rates. A lot of companies die. So at 4 years from seed to Series A, only about 50 companies make that jump. Similar thing from Series A to Series B, about 50% after 4 years. And so just be aware of that. I'm going to end with basically just some books that you guys could check out. So Venture Deals is kind of like a textbook-ish. It's very dry, but it will cover all of this. There's, I think, 4 or 5 versions, so make sure you have the most recent one. And then another one that is less textbooky, but more story-driven, more narrative-driven, but still informative is from this Andreessen Horowitz partner, Scott Cooper, The Secrets of Sand Hill Road. Both of these can be helpful to you guys. So my email's right here. I'll throw it in the chat as well, but open it up to questions.
If we have a non-equity contributor, should we include them in the cap table? I guess I'll jump in as the lawyer here. There's effectively 2 ways that somebody can contribute to your business. They can be equity, either a convertible instrument or a warrant or preferred equity or even a founder, or it can be debt. There is not a third thing. So either they've loaned you money or they have an equity stake in the business. And I will tell you, it does not benefit you for that to be ambiguous, because if it's unclear to everyone how that money is being treated, you're going to end up potentially with a significant dispute between you and the investor if you ever get to a point where the business is actually crushing it. It behooves you to make sure that arrangement is clear on the front end. If it's non-equity, then it's a loan. And if it's a loan, then no, it doesn't have to go on the cap table, but guess where it does go? Your balance sheet. And so when you're creating pro forma financials, it is going to show up on your balance sheet as, hey, we owe so-and-so $50,000, whatever. It also could be a gift, but understand that there are tax consequences to gifts.
Okay, then. Well, if there's no more questions, I just want to say, Kevin, Matt, thank you both so much for today's presentation. It was very insightful. I think I understand pro forma cap tables a little bit better. I wouldn't say I feel comfortable going out and doing one myself, but I feel a lot more confident as to what to expect. And I hope for our audience members, they will as well. If you are a Panache contestant, you will get access to the raw recorded footage of this as soon as it becomes available, so you can review it for your competition. For those of you who joined otherwise, always check out our CoLab YouTube channel, where we'll be posting this video once we have finished editing it and get it up online. And we look forward to hoping you join us next week for next week's masterclass. But in the meantime, stay safe, stay warm, and we'll see you all soon.